The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia. Thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call, and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100. Okay, Sherry, now you can talk.
Now you can say
good
morning.
Good morning.
Here's the thing. If our listeners didn't hear it, it's because she said it in perfect unison with the recording.
The problem is I slept too good last night.
That is a problem.
I finally slept good for the first time in a month.
We have a cat.
Oh, gosh.
We have a cat, a terrorist cat that likes to wake Sherry up at 3, 4, 5, and then goes to sleep.
Jumping on me.
And if Sherry gets up, it will go back to sleep. But as long as Sherry's asleep, it's awake and it's pawing at her and meowing and all kinds of crazy stuff. So I locked Sherry in the second bedroom last night, put chairs in front of the door, and
barricaded
then I slept on the couch with the cat. And the cat didn't bother me. So Sherry woke up all refreshed this morning.
I'm still not awake.
Yeah. She's trying to catch up on weeks of sleep.
I'm telling you what. Anywho, so good morning, everybody. So markets. So Thursday futures dropped as Trump said he would send out take it or leave it tariff letters in 2 weeks. He said that he is negotiating with 15 countries right now, including Japan and South Korea, and added that another 150 countries have not come to the table, and he will be sending them a letter offering them a deal. This guy's busy. Continued disruption everywhere, so just hang in there. Markets will eventually settle down. The big news came Friday morning that Israel struck Iran in an early morning raid on their nuclear facilities. Recent news reports have indicated that Iran was within weeks of being able to actually build nuclear bombs and missiles. This remains an active operation, and we can expect more to come between these two adversaries.
Yeah, I was reading this morning, too, that they're really thinking that oil is going to crest $100 per barrel because of the reduction in oil production.
Fun.
Yeah.
Real fun. I do wonder if Trump sleeps. You just said he's very busy.
I don't think he sleeps hardly at all.
I can't. I mean, he's constantly
Maybe he
active.
Sleeps on that airplane.
Maybe. Or like on the golf cart when he's between holes or something. All right, here we go. Emergency savings account. We're going to bring this up again because it is that important. And we know we sound like a broken record. It's not that we like to talk about the same thing all the time. It's that until people start listening and getting a clue how important this actually is, we want to continue to talk about it. When you have a steady job and paychecks keep coming in and you can pay your bills each month and there's a tiny bit left over at the end of the month, you feel pretty good, right? Then you start next month, rinse and repeat.
And, right. And then the inevitable happens. All the lights on your dashboard light up as you're driving to work, and the repair shop calls you and informs you that the engine is blown and it's going to cost you about $5,000 to replace it.
At least. And we've all been through something like this.
I've driven some junkers in my life, but lucky me, I've never had that happen. Plus, I know how to fix things. But we do own a garage, and as you know, this is the exact scenario is all too common. And a lot of people cry when they find out what the bill is going to be. And often they sell us the car for scraps because they can't even pay to get the tow truck to come and get the vehicle. It's sad.
Yeah, and your other options is a replacement vehicle that definitely does not fit into the already tight budget. Been there. Or even worse, your car gets you to work and you're given a termination notice effective immediately, a no-notice layoff. And in the current job market, you have no idea how long it will take you to find another job that pays what you are currently making. or were making.
That would be terrifying as a parent, not knowing if you could afford the rent to keep your family housed and food on the table just because you didn't prioritize saving for that rainy day. And trust us, the rainy days do come. According to a Yahoo Finance survey, a third of households could not cover 1 month's worth of bills if they lost their job, which is terrifying to me. A lot of people save for a new house or a new car or even a vacation, but not an emergency fund. So if you're one of those 33%, start with something small, say even $10 a week. Make it automatic and build a habit and let that habit take root in your life. And part of that habit will be to resist the urge to touch that money for any reason other than a real emergency.
That's right. And a real emergency is not a new set of golf clubs or the latest designer purse. And some say they don't have extra money to save. And I know there are some people out there living paycheck to paycheck, and many of us have been in that same situation. But for some, it comes down to trade-offs, whether to go out to eat or buy some groceries for a fraction of the cost and cook at home. And maybe finding a less expensive place to live or adding a roommate. Whatever it is, find a way to do it. If you have options, you need to evaluate them.
You really want to put your money into a high yield savings account, but you may need to save up a little bit first, as some high yield savings accounts have a minimum balance requirement to open the account. Then it's as simple as having a drip from your checking account to the high yield account every month. You set it and forget it. If you start small, you'll be amazed how quickly you can build a 3 to 6 month cushion that'll give you peace of mind when the old car dies or when you're handed a pink slip one day. Hopefully not. Don't wait. This is one of the most important things you can do to give you peace of mind and protect your financial security.
And you can go to bankrate.com or Yahoo Finance, and they have pages on there that actually gives you a list of the best high yield savings accounts. Just go look for it.
But seriously, you'll be able to sleep better at night knowing if your kid has to go to the ER or you get in a wreck, or anything could happen.
Or that motor blows.
Or your appliance breaks. Like our last place we lived in, every appliance died
In 1 year.
in 1 year. It was a nightmare, but we had the savings so we could cover it and pay cash for them. So that's should be your goal. That's where you want to be.
I've met with hundreds of people over the years, thousands probably, and the concept has always been that the foundation of any financial plan is there's blocks on the bottom of, if you think about it as a pyramid, right? And that's your financial plan. And the foundation, there's things on the bottom where you have to have those in place before you start the savings or before you start trying for retirement or other goals or buying secondary homes or whatever. One of them is the emergency account, and then other ones are like health insurance, life insurance, disability insurance,
Right.
because those are things that if anything happens, none
You're
of the
covered.
rest of the stuff above it matters,
Right.
right? Because your financial plan is completely off track if you all of a sudden you need 10 grand and you don't have it.
Yep. And we're going to talk about this later, but I read an article this week that Gen Zers just don't want to even save at all, much less an emergency savings account because, you heard the phrase YOLO, you only live once.
Right.
And they just feel like there's no way to even get ahead in this world, so they just don't even care anymore. It's not all of them, but there's a high proportion of the Gen Z
A lot of apathy that's going to catch up.
is going to catch up.
Well, it's like the six kids that are inheriting from one of my clients that just passed. Is they have no savings whatsoever, and they're all in debt, and so we're cashing the money out and giving it to them to help them try to get to the next level. I'm encouraging all of them to please start saving some money. You can't keep going out and buying stuff on time, expensive cars and big car payments and rents and all of. You can't get anywhere doing that.
That's right.
When you're young. So anyway.
Well, here's the thing. I just want to say this because each of those clients is not inheriting a ton of money.
No.
Right. But I can say from personal experience that even when you get something like a $20,000 or a $30,000 windfall, that's life changing because of what it allows you to do
Different.
right then that changes what else you can do in terms of saving or, building up something else. And so it can be life changing to have something like that
Oh,
where
yeah.
you can knock out the debts that have been killing you for
As
years.
long as you change your behavior moving forward and quit getting into so much debt. That's the thing.
Right.
You can't be 30 years old and keep borrowing and borrowing and borrowing.
Right.
This should be a life changer. It should be.
And we have a special report on our website, retirerelax.com, and it's titled for the instantly wealthy. Now, granted, $50,000, $60,000 is not going to make you wealthy, but what the report gets to is that about people changing their behaviors once they get money that they've never had before, and a lot of times getting $50,000, $60,000 is a level of money many people have never had in one bucket at one time,
Right.
you know, and they're going to go out and blow it. And they're going to buy things that in a year or two, they're going to wish, oh gosh, I wish I had that money back. You know, they go out and buy a big old truck, you know, and as soon as they drive it off the lot, it's worth 50% of what it was worth the day they gave them the cash.
Well, here's the one that really gets me still. Is I had a client die unexpectedly, and each of these two kids got $250,000. And one of them was like, well, I have to take it out in 10 years because that's the new IRA 10-year rule, which is horrible. I might as well go ahead and spend it now. So she upgrades her house and buys a bunch of furniture, gets a new car. It was blown in 2 years. And that money could have been probably worth $1 million at least by the time she retired if she could have left it alone or reinvested it.
No question.
Yeah.
No
Anyway.
question.
That's where a good financial advisor can really help guide you if you're willing to listen.
She didn't want to listen.
And then there's that.
Right. Were you going to say something else, Jonathan?
No, I just scenario is you know you have $20,000 of credit card debt, and every month you're just drowning, paying off mostly just interest just to keep it
Right.
flat.
Yeah.
You inherit for whatever reason $40,000, let's say, and instead of paying your $20,000 off and using the money you were using to pay down interest every month and saving that, if you go out and just buy something else and leave the $20,000 of credit card debt, that's the second part. That's what you were saying.
You're
is
not getting anywhere.
You have to change your habits also.
Yes.
But it can be life-changing money.
It can.
be. Yep.
Absolutely. So here's a fun article. On May 21st, Mikhail Baker graduated from Mill Creek High School in a suburb of Atlanta. He might have known it was a day that would change his life when he woke up, but he absolutely didn't know how the extent of that change. After the ceremony, Baker and his parents went to a local Burger King to grab dinner. That's pretty exciting.
That's your favorite place.
Baker had worked there since February to save money for college, and the family could eat at a discount. When they walked in, though, the place was booming, and there were only 3 employees trying to juggle cooking the food and handling customer orders. Baker volunteered to help and got straight to work while still wearing his graduation medals and sash. A bit later, Maria Mendoza pulled up to the drive-thru and spotted Baker. She shot a video of him hard at work and posted it on TikTok, where it went viral. People asked how they could help Baker with his college expenses, so Mendoza launched a GoFundMe campaign. As of last Friday morning, that campaign had gathered over $201,000 in pledges. She said, while many graduates spent the night celebrating with friends and family, one young man quietly showed the world what determination looks like. Mendoza and Baker didn't know each other. She happened to be at the restaurant to pick up food for a party celebrating her own daughter's graduation from Mill Creek. Baker wasn't aware of the video or the fundraiser until 3 days later when Mendoza spoke with the manager at Burger King asking to meet him. The fundraiser at the time had collected $6,000. I didn't realize she was recording me, Baker told the Washington Post. I felt very happy. I was surprised. I had never seen that much money in my life. I'm very thankful to everyone who has donated and supported me through this journey. Beyond the money raised via the GoFundMe, Burger King has presented Baker with a $10,000 scholarship as well as a $10,000 scholarship for Mendoza's daughter. Baker had planned to take a gap year to save for college. Now he says he has applied to a technical college and plans to study automotive tech this fall with plans to become a mechanic, which in Georgia you can do that for free, so hopefully he gets the same deal. Until then, though, he plans to keep working at Burger King. I just love working, he said. The people I work around make the job more fun. This guy is going to be just fine, and the technical education, if he was in Georgia, would be free, which I already said. He could use that money to buy a house. Talk about a life change
Yeah.
at an early age.
He'll be able to fund all the tools he needs with that kind of money.
Right.
So, that's pretty cool.
It is really cool.
All right. Shifting gears here, no pun intended. Sam Altman, who's the CEO of OpenAI, says that companies are using AI agents, which is the program that runs autonomously to perform complex tasks, says that they were being used as if they're junior employees. Altman says that now you hear people say that how their job now is to assign work to a bunch of AI agents. Then they look at the quality and figure out how it fits together, and then give feedback to the AI agents. And that sounds a lot like how they would work as a team of junior employees, only if they were humans, except these are AI agents. Meanwhile, a report last month from SignalFire found that AI has already led to a 25% decrease in entry-level hires from 2023 to 2024 at Meta, Microsoft, and Google. SignalFire head of research told TechCrunch that AI was to blame for the decline in entry-level tech roles as it takes over more and more routine tasks typically carried out by junior employees. At the consulting firm McKinsey, AI is performing tasks usually reserved for junior employees, like creating PowerPoint presentations and drafting proposals. McKinsey wrote in July that AI could replace up to 375 million jobs by 2030. But we've seen this coming.
Right. Other industry leaders have bold predictions about how quickly AI will take over entry-level jobs. At Anthropic, AI could eliminate half of all entry-level white-collar jobs within the next 1 to 5 years, causing unemployment to rise as high as 20%. It sounds crazy and people just don't believe it, but that came from the company itself. And I have to add that while it's taking these jobs away, you also have massive amounts of people retiring every year. So I think it's all going to work out.
Yep. Here's another good article about what AI can do for a company. Rerig Pacific company is probably not what most people picture when they think of a company that develops software. They're a fourth-generation family business founded in 1913. The company got started manufacturing reusable wood crates for the dairy industry. It expanded to plastic crates in 1960 and then built out its product lines on even more varied plastic containers, including garbage bins and boxes for Coca-Cola. But as an example of how brick-and-mortar manufacturers are finding ways to take their original transformation to the next level by leveraging the power of the cloud. Since the early 2000s, the container manufacturer had a system where they placed RFID, which is radio frequency identification tags, on its containers, which not only helped the company track its shipments, but it also helped customers track theirs, since many use those same containers to transport their own goods.
When it began the project, the company was hosting all of the data with its own servers located on premises. That meant that one power outage near its servers could take down the entire system, and the company's systems weren't connected to each other. In other words, its data on which containers were where wasn't integrated with, like, its data on its customers, for example. So they decided to migrate its existing data to Amazon Web Services, or AWS, a secure cloud service, and now they're reaping the rewards. Now they, along with their clients, can see exactly when the truck is loaded and where it is in transit and exact delivery date and time.
Which is great. Rerig Pacific's experience is part of a broader trend as manufacturers have found that the cloud can provide real value, not just buzzy tech startups, but also to factories and other industrial players. Shortly after cloud computing initially came on the scene roughly 2 decades ago, researchers proposed that by tapping into the cloud, manufacturers could more easily collect real-time data from the factory floor or centralize information formerly spread across a host of computers into one data source. Companies saw the sea change and responded. In 2019, for example, Volkswagen connected 124 of its factories to AWS's infrastructure and ran data from the shop floor into AI and machine learning algorithms. And that same year, Titan, a wheel manufacturer based in Illinois, employed Oracle to help better collect factory data in the cloud and predict machine breakdowns.
Yeah, but still, manufacturers haven't fully tweaked their business infrastructure to take advantage of cloud technology, according to a survey commissioned by AWS and the tech titan IBM. From June to July 2023, the two companies polled more than 1,100 manufacturers in 21 countries and found that almost half said that they could better use the cloud to add value. Rerig Pacific is one of those manufacturers that they're trying to and succeeding in using the cloud to add value to its business. Because Rerig Pacific is already firmly in the cloud, it recently started to make use of Amazon Web Services' existing software toolkit to see how it can leverage generative AI. For example, over its century-long history, the plastic container manufacturer has produced more than 14,000 pages of technical reference material for its engineers working on the factory floor. Now, if those engineers need to understand the company's machines, they don't need to flip through 3-ring binders. They just ask AI. They're on the floor with an app on their phone, asking a chat box a question and getting their answers.
Here we go.
Pretty cool. All right. Seems like we talk about this a lot, but here's your Central Georgia Technical College update.
People don't know about this stuff.
I know.
I talk to people every week who have no idea that their kid could do this.
It's a great program. The CGTC Foundation, which is Central Georgia Tech, announced that it has received a planning grant from Bloomberg Philanthropies to support the establishment of a regional STEM healthcare high school in Houston County. The planning will be undertaken through a partnership between the Houston County School District and Houston Healthcare. And Central Georgia Technical College is aimed at establishing career-connected learning opportunities to strengthen Central Georgia's healthcare workforce. The grant will fund personnel and programming needs for the regional high school and bolster support already committed by local and state leaders. CGTC, HHC, and Houston County School District, the 21st Century Partnership, the other community organizations have all been collaborating on this initiative with local, state, and federal elected officials since 2021. And the financial support from Bloomberg Philanthropies will enable the initiative to move forward.
The Regional Healthcare High School program will be an innovative educational approach focused on providing students with training and skills to pursue high-demand career opportunities within the local healthcare workforce. The regional approach will allow students from multiple school districts to explore healthcare education throughout the high school years. After enrolling in the STEM Healthcare High School program, students will be able to work towards their college credentials in programs such as ultrasound and respiratory technology, hemodialysis, cardiovascular and radiology, and nursing with paid internships. As a result, graduates will be prepared for high-skill, high-wage positions within healthcare organizations throughout Middle Georgia. This planning grant stems from the first of its kind $250 million initiative launched by the 2024 Bloomberg Philanthropies that is connecting healthcare and education systems to create new high schools in 10 communities across the country. This will be the first healthcare high school Bloomberg Philanthropies has supported in Georgia. And Alliance members will visit existing sites to learn the best practices and establish plans for the regional STEM healthcare high school.
So yes, Warner Robins is 1 out of 10 cities in the entire country to get this program,
Amazing.
Which is just amazing. Alvin Harmon, CGTC's Associate Vice President, said, "Our goal is to expose students early to a healthcare career in the 9th and 10th grade so we can seamlessly move them into clinical training toward the 11th and 12th grade. And when they graduate, move them seamlessly into the workforce," which is phenomenal. The school will be open to students again across the region, not just Houston County. The plan includes free transportation, laptops, and opportunities to study in fields like we mentioned, nursing, radiology, and surgical technology. The need for new healthcare workers is growing. According to the Federal Health Resources Service Administration, Georgia has 21% fewer registered nurses than it needs. If the trend continues, the state could face the nation's second largest shortage by 2035. And I'm hearing this from all of my clients that are in the medical field. Harmon said the program could help close that gap, especially in rural communities. Students can begin healthcare courses now through CGTC's dual enrollment program. Harmon said they expect the high school to open next year. Please tell your kids and grandkids about this. What a great opportunity, a good paying job, and no student loan debt.
Right.
I mean, just awesome.
Yep.
So next up, without an above normal hurricane season forecast, check these 3 things in your home insurance policy. The National Oceanic and Atmospheric Administration, or NOAA, predicts a 60% chance of an above normal Atlantic hurricane season, which spans from June 1 to November 30th. The agency forecasts 13 to 19 named storms, including 3 to 5 major hurricanes of Category 3 or higher. Now is the time to check your home insurance policy and make necessary changes. Hurricanes can cost billions of dollars worth of damages. Experts at AccuWeather estimate that last year's hurricane season cost $500 billion in total property damage and economic loss, making the season one of the most devastating and expensive ever recorded. Review your insurance policies and what coverage you have. You want to know 4 key things: the value of property at risk, how much a loss could cost you, whether you're protected in the event of flooding, and if you have enough money set aside in case of emergencies. Insurers often suspend policy changes and pause issuing new policies when there's a storm bearing down. So acting now helps ensure you have the right coverage before that's an urgent need. Here are 3 things to consider about your home insurance policy going into hurricane season, according to experts.
First, take a look at your policy's limits, which represent the highest amount your insurance company will pay for a covered loss or damage. You want to make sure the policy limit is correct and would cover the cost of rebuilding your home. Most insurance companies will calculate the policy limit by taking into account the size of your home and the construction cost in your area. For example, if you have a 2,000 square foot home and the cost of construction in your area is $250 per square foot, your policy limit would need to be $500,000. You may risk being underinsured, however. especially if you haven't reviewed your coverage in a while. Rising building costs or home renovations that aren't reflected in your insurer's calculations can mean your coverage lags behind the home's replacement value.
Repair and construction costs have increased in recent years. In the last 5 years, the cost of construction labor has increased 36.3%, while the building material costs are up over 42%.
Oh, it's just horrible. We went through it building that loft.
Yeah.
Oh,
Yeah, you guys have experienced it. Most insurance companies follow what's called the 80% rule, meaning your coverage needs to be at least 80% of the replacement cost. If you're under, you risk your insurer paying less than the full claim. Next, take a look at your deductibles, or the amount you have to pay out of pocket up front if you file a claim. For instance, if you have a $1,000 deductible on your policy and submit a claim for $8,000 of storm damage, your insurer will pay $7,000 and you pay $1,000.
so raising the deductible from $1,000 to $2,500 can save you an average 12% on your premium. And look over hazard-specific provisions such as a wind deductible, which is likely to kick in for hurricane damage. Wind deductibles are an out-of-pocket cost that is usually a percentage of the value of your policy. As a result, they can be more expensive than your standard deductible. If a homeowner opted for a 2% deductible on a $50,000 house, their out-of-pocket cost...
500.
Sorry?
500,000.
Oh, sorry. I'm a zombie today.
You're good.
Their out-of-pocket cost for wind damage can go up to $10,000. Randy, we need to pull our policy out and look at them again.
Yeah. And assess if you need flood insurance. Floods are usually not covered by homeowners' insurance policies. And if you haven't yet, consider buying a separate flood insurance policy through the National Flood Insurance Program sponsored by FEMA or through a private market insurer. It can be worth it whether you live in a flood-prone area or not. Flood causes 90% of disaster damage every year in the United States, according to FEMA. In 2024, Hurricane Helene caused massive flooding in the mountainous areas like Asheville, Buncombe County, North Carolina. Less than 1% of households there were covered. If you decide to get flood insurance for the National Flood Insurance Program, don't buy it at the last minute. There is usually a 30-day waiting period before the policy goes into effect. And make sure you understand what is protected under this policy. It usually covers up to $250,000 in damage to residential property and up to $100,000 on its contents. So if you expect more severe damage to your house, ask an insurance agent about excess flood insurance.
I've got one more thing for you to talk about on this subject. So how our lake house flooded.
Our lake house flooded only because of an air handler
Yes.
unit, and that is not covered under flood insurance.
Right, okay.
So
When you read that statistic about $500 billion in claims in 2024, which was a record, I wondered when you said that, how much of that was Helene. And then reading this that you just said, Randy, less than 1% of households were covered with flood damage.
Terrible.
I wonder how many people just got completely...
They just walked away from
wiped
their
out.
properties.
Right.
most
just
of those
wiped
properties
out.
up there have not even been rebuilt, and FEMA has been so slow getting them any kind of relief.
Man.
Yeah, terrible.
That's terrible. So yeah, please look at your policy.
You've been listening to Your Money, produced by Lifespan Wealth Management with your hosts, Sherry Goss, Randy Goss, and me, Jonathan Eisner. If you'd like to contribute to the show, you can email Randy at rfmoney.com with a question or topic that you'd like us to cover in a future broadcast. Our number is 478-922-8100. We have offices in Macon and Warner Robins for your convenience.
And you can find out more about us by visiting our website, retirerelax.com. Lifespan Wealth Management has been serving the Middle Georgia area for over 30 years, helping people like you achieve their investment and retirement goals. And if you're in need of a financial advisor, please contact our office at 478-922-8100.
We also offer seminars to the community at no cost. So if you are in need of a guest speaker for your church or civic organization, give us a call and together we can decide what topics you would like us to present to your group.
Again, our contact number is 478-922-8100. Now back to the show. All right. Today we're going to talk about consumerism. And consumerism is a social and economic ideology that encourages the acquisition of goods and services in an ever-increasing amount. It is both a cultural mindset and a system of behavior driven by the belief that the personal happiness that you have and social status are closely tied to the consumption of material goods.
And I think social media has created a spending nightmare. We've all heard this saying, keep up with the Joneses. It's an old saying, right? Buying stuff you don't necessarily want or need or even like just to impress or, well, to keep up with whoever it is you're trying to impress.
Yep. So let's talk about the problems that come along with it. Buying stuff you don't necessarily like. Spending your hard-earned money on those things you don't necessarily need. 3, buying stuff that can lead to living beyond your means. 4, if you're paying for these items on credit cards, it means paying high interest on that debt. 5, if you're paying on revolving debt, you're probably not saving and probably don't have an emergency saving account for those rainy days. There's that emergency savings account again.
Exactly.
Very important. Number 6, poor investment decisions, if any at all. Number 7, you're charging items and not saving. This could cause chronic stress and anxiety.
Especially when those bills start piling up.
For sure. Number 8, if you're constantly broke because of overspending, it could lead to envy and resentment of others who seem to have more money and prosperity. 9, because you're basically trying to live someone else's reality, you could be neglecting your own goals. And number 10, you'd be substituting short-term gratification over long-term fulfillment.
I just had a brainstorm that is not in this article. Back in the day, I had to write checks, physical checks to pay my bills, physical checks at the grocery store, physical checks about everywhere. And then I got a credit card and only used that for certain things and still wrote checks to pay the bills. So it made me have a very high awareness of where the money was going. Today, and our daughter was an example. She went to college and she couldn't tell me what she was spending her money on because all she was doing is swiping a credit card.
And she wouldn't look at the statements.
Yeah, she wouldn't look at the statements. And so she was just oblivious. And the kids that she was going to school with, and this was what, 30 years ago? No, 20? 20 years ago.
Maybe 15.
Yeah. They all had their parents' credit cards. And they would swipe their credit cards everywhere at the liquor store, at the bar, going out to eat all the time, buying more clothes. And she was trying to keep up with those people.
Yep.
And so she was working at one point a bunch of jobs. So it's just, it has changed so much. You've really got to sit down with your kids and talk to them. Anyways, the problem is that trying to keep up with the Joneses is a losing battle. There will always be someone with more. The better path is to define what success and happiness mean to you, choose to live within your means, and build a life rooted in purpose and security, not appearances. Social media plays a big role in this now. In the Stone Age, we just talked about that. When Randy and I were kids, there was social pressure from the neighborhood kids and maybe the workplace, but we didn't have an entire world in our face showing us how much better dressed they were or how much nicer their house was than ours. Thank goodness.
Yeah, right.
So, Jonathan, how is it with your kids? What are they having to deal with?
My kids are not on social media, thank goodness.
That's amazing.
Good for y'all.
Yeah, for sure. And they haven't ever even asked. They probably know what the answer would be.
They probably have a hidden tablet somewhere, you know.
I hope not. I hope not. We try to monitor all that stuff very closely. They do, though. They do watch a lot of stuff on YouTube. And so I'm sure some of the same sort of things come into play, you know, with social influence and style and status and all this. Fortunately for us, our kids seem to have a pretty good sense of what's practical and realistic for them over what they see kids doing on the videos they watch.
Well,
Right.
good.
And, you know, none of us are immune to consumerism. And I mean, none of us. Okay, YouTube, think back in time. And this is where one thing that you purchased just because everyone had one of those things, you know, what was it? A pet rock, sneakers, a car, whatever. You know, I just wonder, has there been a time in either of your lives when you wanted to buy something and you went out and just bought it? And the very next day you had buyer's remorse. I remember two things, and they were not expensive, but they were hot and they were in the clothing market. And then back in the day, I went out and bought two things. Remember the parachute pants and the
I'm
members
trying to
only
remember
jacket?
parachute pants.
Yeah, they were not.
They were pretty horrible.
They were pretty horrible. And I bought them, and I hated both of them as soon as I bought them. And
I hate members only jackets too.
and I think I wore them one day, and I kind of hung it up in the closet. But, you know, and I purchased these in Idaho, and the only vehicle I had was a motorcycle, and they were not warm. That was
Oh,
terrible.
brother.
What about y'all? What did y'all buy?
My stupid car story. I thought a car would make me popular. Whoops. Didn't work at all. It was a really cool car too, but it didn't matter because I was still a nerd. Second up, renting a really nice apartment on a very low wage as I wanted to fit in. Total mistake. Nobody cared where I lived. And then when I met Randy, I was living in the cheapest apartment I could find in Boise, Idaho, and driving a horrible car. He didn't care, so there you go.
Yeah, that must have been a real step down based on that car in the apartment. I had to take you out for a charity lunch when I first met you. You were so
Right.
emaciated.
I wasn't making any money, man. I was scraping.
Yeah, we've probably just about all seen with a car or two, and cars you can't afford in the first place get really tricky really fast.
They do.
I had a good friend of mine one time who was already in a car she couldn't afford, and when she needed the next car, which was even more expensive than the one she was in that she couldn't afford, she was like, "It's not a problem. I'll just roll the negative." They just told me I can just roll the negative equity into the next purchase.
They just don't understand, do they?
It's like, oh, it's that easy, so I don't have to pay the old one off that I'm under water on.
It
It's
blows my mind.
You're going to pay it off just a lot more.
Yeah.
Horrible. So Randy and I have seen so many people do this, and a lot of it is driven by how they want to be perceived as successful. It doesn't work. It didn't work for me. So let it go. You can be very successful and still drive an old car or a truck. In fact, this is a major point in the book, The Millionaire Next Door. None of them drive fancy, expensive cars.
Right.
I would venture to say that driving a very expensive car is more negative, not just because of the financial aspect of it. It's more negative than positive because then people have this perception of you that isn't necessarily a positive one, right? They're like, oh, well, he can drive that car around town, but he can't do this or that. And, so you have people drumming up these thoughts in their mind, and you probably can't afford the car in the first place.
Yeah.
So there is that too. I did have a very nice car when I started working with you guys. You guys remember it? My Tahoe?
Yeah.
And it was a very expensive car. I probably had no business paying for that car, the cost that it was, but I did love that car.
Yeah.
And I felt very good driving down the road in it, but I don't miss it.
Yeah.
I don't miss it. I'm
Or-
much
or
more
the gas
affordable
bill.
car. Or the gas bill, exactly. And at home, I have my probably the thing I can relate most with this on is that I have a lot of guitars, a lot of guitar amps, a
And
lot of
that
equipment.
that you can play very well.
Well, thank you. And Randy, you've seen most of my collection. I think I've shown you pictures of it. I have 9 guitars hanging on the wall in my office at home, 4 amps. I have tons of pedals, probably 15 pedals. More than half the guitars on that wall don't ever even come off the wall.
But they probably look nice.
They do look good. I am proud of the collection. They do look good. But guess what? Nobody else cares. So just like when I drove a Tahoe, nobody else cared. The amps rarely get turned on. And even when I do plug in and play an amp, it's one of them. And the foot pedals, I won't even go there. I haven't played a foot pedal in probably 10 years. So I definitely got caught up at one point on keeping up with the proverbial Joneses on guitars and my equipment and all that. And now I could literally have about 20% of that stuff, and I'd probably be just as happy.
Right.
So do your kids want to learn to play?
No, I wish they did. I tried. My oldest, I got him. Well, I actually have 10 guitars. One's not hanging up; it's in a closet. But it's a smaller, nice guitar. And when he was about 7 or 8, I got him a book, Randy, kind of like the ones you've been learning in, and an introduction to guitar. And he played for like a day and a half, and that was the end of it. That was the end of it.
Funny.
Zero interest
awesome.
since then. And one of my kids does play violin in the orchestra at school, and he loves it. So I'm hoping he sticks with that.
Yep.
But
Very good.
other than that, very little interest.
Sherry, what about our kids? What do you remember? What were their spending choices? Was it purely consumerism? I remember Preston always wanted to buy golf clubs.
But if we did, he actually used it as he was on the high school golf team, and he wanted to be. He was really good. He was a natural golfer. It blew my mind when he tried out for the team. Had hardly ever played in his life. Made the team, and within 6 months, he was on the varsity team. It was mind-boggling how that went for him. So, anyways, so buying a golf club for him, I didn't mind that at all because he was out there practicing every single day and playing in all these tournaments and stuff. So our daughter believed that she had to have a certain level of clothing, and I get that. And she also had to have her hair highlighted. The best thing we did was during her senior year, we put her on a budget. So she had to decide how to spend a specific amount per month for everything she needed. It was amazing how her spending choices changed once it was her money. She went to the dollar store. Right. She'd never been in a dollar store in her life. She comes home all excited about this cheap stuff that she found.
Yeah. All right,
let's learn how to budget.
Right. Let's hop back to that list. I can remember growing up and going over to my friend's house, and I can remember 2 things about his mother. This lady's yard was full of every sort of concrete known, bird bath, and other concrete yard ornaments she could cram in the place. The other thing I remember is she drove the most blinged out Cadillac on the market, where she kept spit shined and polished and parked proudly in front of her single wide mobile home. And she bought a new one every year. Back then, I never really wondered about the choices of the living quarters and the vehicles and where you were spending your money. But today I look back on that whole scenario and I wonder why she chose to spend her money in those ways. Could she have lived in a nicer home and drove a less expensive vehicle? Yes, undeniably. Did she have a problem with how she was living? Undeniably, no. Her home was always neat as a pin, and she was a sweet lady. And back then, in that era, mobile homes were the new housing and hot commodity. I can give you a real life example of people living beyond their means. A friend who has for years been coming to Sherry and I for advice. Literally all 10 of these items that we mentioned earlier in the list are the culmination of their life. And it is sad because we have explained how not to be in those predicaments over and over to them in the predicament they're in today. But they cannot stop spending.
And now they are reaching retirement age and freaking out as their options are very limited. So bad decisions can lead to stress and anxiety. I don't see a lot of this, but when I do, it is really heartbreaking to see prospects who come to us that have not saved enough or have spent down their savings by spending on items they really didn't need, basic consumerism. Then reality sinks in. They suddenly realize that they are in relatively good health and they're down to their last few dollars, however much that may be, and they can see lean times on the horizon. And to make matters worse, they still have bills coming in for some of the new toys they purchased on the last spending spree. Now, please don't get me wrong. We don't think you should just save all the money and you should just give it all to your beneficiaries. We really believe that you should enjoy some of the spoils while you're alive and able, just as long as you understand why you saved money in the first place for your care and retirement. And that is why we are here as financial advisors.
So me personally, I like my stuff. I'm not necessarily a statusy person, but I like to have my stuff, my guitars and my Tahoes and all that.
Right.
But I'm also very saving is a high priority for me as well. And so it's not one in place of the other. And so this year I decided to try something. And at this moment, I'm very glad I did. What I decided to try was to get our retirement accounts, the ones Katie and I have, fully funded for the entire year before I spent money on some other discretionary things.
Smart move.
I knew early in the year that there were some things we wanted to buy or wanted to do, but that we would also want to max out our retirement by the end of the year. Or at least that maxing out the retirement was the goal. So a lot of our extra money for the first several months of the year was used to fund the retirement accounts. And now they've been fully funded for 2025. And we got 6 months left in the year. And so I have peace of mind about it. It's like I couldn't even put more into those even if I wanted to. And so now if I want to spend on something discretionary, well, the better priority, the higher priority got funded first. And so for the rest of 2025, got some peace of mind. Hopefully we can do the same thing in 2026 and on. But goal accomplished this year. I'd encourage other people to do the same.
That was a good goal.
Thank you.
Can I encourage you to opening up an individual account? I'll set that up for you after the show.
Yeah, absolutely. I'll come see you. Do you guys believe that people know when they're living beyond their means, or if they do know or should know, why do they continue to spend the way they do? Is it just a cycle that they can't get out of, or just what becomes the norm? And
That's a good question.
What's another $1,000 on the credit card?
So I don't see how they can't understand when they sit down and have to look at the bank account every month. They would have to be in a complete state of denial. And some people create money habits to stick even when they can't afford it. And if they're in debt at some point, the creditors could be knocking on the door and calling night and day looking for some form of payment. I don't see a lot of this, but when I do, it makes me really, really feel just sick.
I agree. And it's either that or you're just terribly bad at math. After all, it's simple math. You start with what you make, you subtract what you spend, and you stop before you blow past zero.
As for the second part of the question, why do they continue to do so? A big part of it has to do with social media or how they appear to relatives. That's what I've seen anyway. Too many people are trying to impress or keep up with other people, and if they can't afford to do it, it's a disaster. The other piece I hate to suggest is that people have shallow values. And what I mean by that is that they get happiness from materialism and images, not substance. True happiness gets sidelined.
I agree, Sherry. It's truly what we opened the show with, social status, keeping up with the Joneses. People feel pressure to match their peers' lifestyle, even if it means overspending. It does not matter if one person has become a doctor and is making $300,000 a year. You might want to impress them by buying dinner on your $50,000 salary. It really makes no sense.
No, that does not. I think those are both good points. I think lack of financial education and easy access to credit has added a lot of fuel to the fire.
Agreed.
And I'll add one more thing. We live in a time of instant gratification, which was mentioned earlier. People are not willing to save up and pay cash for things. Gen Z seems to have a case of economic malaise. We mentioned that earlier too.
Yep.
A recent poll from Credit Karma shows that nearly half, or 49%, of its adult members, the oldest of whom are in their late 20s, say that planning for the future feels pointless. I think that's what you were
That's what I
alluding
was
to
talking
earlier,
about.
Randy.
Yep.
That YOLO mindset, YOLO being you only live once, among the Gen Z, which is those born specifically from 1997 through 2012, very dangerous mindset.
Yep. If left unchecked, it might lead young adults to rack up high interest debt they can't easily repay, perhaps leading to delayed milestones like moving out of your parents' basement or saving for retirement. All of these can easily lead one to living beyond their means. When that happens, they start charging up their credit cards. And according to Forbes advisors, the average interest rate on credit cards right now is a whopping 28.67%. Ouch. When you start paying this level of interest, you're on a terrible slope that is hard to recover from, especially if you're living paycheck to paycheck.
Yeah, and what about the buy now, pay laters that we talk about almost every week?
And I've got some more on that in just a second.
That's been added to people's plates too as an option for paying for things. It's added fuel to the consumerism. Now you can finance anything you want, even things you traditionally never financed before, like groceries, a hot dog. When you're out shopping at the Sam's Club. That's hilarious.
Oh,
Motley Fool reported that in 2024, 15% of Americans used buy now, pay later services. Based on the U.S. population, that's about 49.5 million people. And 24% of those made at least one late payment. A fourth of them made a late payment on a hot dog. No.
oh my God.
Now, in the first quarter of 2025, the Swedish buy now, pay later provider Klarna says that their net losses doubled in the first quarter of 2025 as consumer losses rose 17% year over year as more BNPL users missed payments. These losses exceeded $136 million. And now Bankrate.com has reported that late payments are growing across the entire BNPL sector.
Sherry, I have to give you credit for this. I believe you predicted this this version of the buy now, pay later program would happen when it first rolled out.
I did. It was too easy to get and just creates a whole new terrible habit. But that is really how unsecured debt really works. Let's be realistic. This is why banks want collateral before you open the vault and give you a loan. They want you to have skin in the game. And the lower the barrier to enter the game, the more likely it is that someone will default on the loan. It doesn't matter what the program's name is, buy now, pay later, or Freddie Mac housing program with no money down because everybody deserves a home like we saw back in the 90s. Yeah, I could see this coming a mile away.
But I don't feel bad for the buy now, pay later firms. They knew going in, or at least they should have known going in, that there's a high probability of default for some percentage of people.
Yep, I agree. But what I find amazing is that they did not, at least at first, have these buy now, pay later programs tied to the credit reporting agencies. I think if they did, people would have taken the repayment obligations a little more serious.
For sure.
And as we said, that roughly 49.5 million Americans with buy now, pay later accounts. And if 25% of those reneged on the obligations, that could have been a catastrophic blow for most any company. But I believe what these losses mean is that the cost of these programs is going to rise for anyone who uses them. I was reading a Consumer Finance Protection Bureau report on this very subject as a sleep aid. But here are two very interesting facts from the report. Borrowers with subprime or deep subprime credit scores make up the majority of buy now, pay later originations.
Go figure.
Go figure, right. BNPL default rates remain lower than credit cards. I found that surprising.
That is.
Likely due to automatic repayment requirements on some of the programs, not all. On average, between 2019 and 2022, BNPL borrowers defaulted on 2% of the BNPL loans. In comparison, BNPL borrowers defaulted on 10% of credit cards they held during the same period.
Gosh, they're destroying their credit.
Right.
Very interesting statistics there. Where are we right now as a nation historically with regard to debt, Randy? I mean, you have the data on that, right?
I do. Actually, we keep all sorts of data from many sources. Household debt Service as a ratio, meaning debt payments as a percentage of disposable personal income, is 11.3 at the end of the first quarter of 2025. And to give you some reference points to compare that to, in 1980, the ratio was 12.4, and at the end of 2007, it was 15.8. So there was some improvement. So let's take a look at mortgage, student loans, credit card data, and auto loans. Right now, we're seeing an uptick in mortgage loan delinquencies. VA and FHA loans are the main drivers of these, while conventional loans are relatively unchanged and very low. And to be expected, student loan delinquencies show a real sharp spike since the program restarted the repayment program. That's because many borrowers were not prepared to start making payments and have fallen into delinquencies. Credit card delinquencies, according to the Fred report, has surged from February of 22, where it had stabilized at 14.56. And take note of this jump here. As of 2025, the delinquency rate has jumped from that 14.5 to 21.37, which is terrible. And last, there are auto loans. Since 2021, the auto rate delinquency has steadily been on the rise. Data from YCharts.com shows a steady upward trend in auto payment delinquencies for the 2.5 years, and it's just a steady increase.
I've read it's because of the price of the cars. The price of the cars are so high, and people fall in love with it, and they sign the paperwork, not realizing that they can't afford the payment.
Right.
And I don't understand why we allow people to have so much debt. I don't get it.
The price of the cars and coupled with the
Insurance.
rates.
Oh, the insurance
For sure, but the rates to finance those cars has been higher since 2021 as well. If you're constantly out of money because of overspending, it could lead to envy and resentment of other people who seem to have their money and prosperity more in line. Because you're basically trying to live someone else's reality, you'd be neglecting your own goals.
So we have a friend who invited us out to a social the other night and met at a great little place in Macon called Churchill's. It's a cigar bar, but it's very nice, and you don't leave smelling like a cigar, or I would have never gone back for a second visit, which we have. Anyway, the daughter of the guy who invited us is in medical school, and she was telling us about the parties and the school she attends. The people at this school are some of the richest people in America. She has been introduced to young adults who come from families who own stores like Nordstrom's. The refreshing thing about listening to this young lady was how grounded she is. She understood that she did not have the money that they do, and she was not trying to pretend that she had that level of money. She's not hounding her parents for money all the time to keep up with the Joneses. If they wanted to invite her to a party, that was great, but she felt no obligation to go out and buy a new outfit or just trying to fit in. She understands that spending money like that simply would be sacrificing her long-term fulfillment for short-term gratification.
That's refreshing.
It was amazing to hear.
Well, and besides that, if mom and dad aren't willing to pay for the clothes and jewelry to fund the lifestyle, then she probably have to charge it. Then comes the stress of having to pay credit card bills, worrying about credit score, etc.
Yep.
Our daughter went through this when she was in college. She was on a budget and had the amount of money she needed, but at one point she had 5 side jobs just to bring in enough money to keep up with her friends.
Yep.
It was ridiculous, and I couldn't get her to stop.
Yep, I agree. And I think we all agree that there's nothing wrong with buying what you want when you want it. Wouldn't you guys agree?
If you can afford it.
Yeah.
Right.
However, if
Within
you're buying something, regardless of what it is, that's your right. If you are one of those people that must spend every dime you make, then I think you need a financial plan and a financial advisor to help guide you so that you can experience financial independence at some point in your life.
Yeah, it's a great goal. I think where you're going with this, Randy, is that when people are saving for retirement, they're piling up money, and often they save so much that they may never spend all of it. But there are certainly fewer people in that bucket than not. If you do not have your retirement goals fulfilled, or worse, you have not begun to start the process of saving for retirement, then you really need to. There's no time like now for that. I can help with it. We can work together and build a financial plan and get you started on a program to start you on your path to financial independence. And if you are a small business owner, you owe it to yourself and your family to take a look at what we can do for you to help secure your future.
Helping people reach their retirement goals is what we do each and every day, and we are good at what we do. As certified financial planners, we get to know you, your family, your goals and aspirations, and help guide you through how to invest and reach your financial goals. And the point of this show is not to say you can buy things that you want. What we want to convey is that you don't need to try to keep up with the Joneses. Play your own game of life. Be your unique self. Use debt wisely, if at all. And if you do use a credit card, pay it off every month before the reporting date so you don't pay any interest, and your credit score will get better. And please steer clear of buy now, pay later plans. If we can be of service to you, please give us a call. Our number is 478-922-8100. And don't forget to check out our website, retirerelax.com.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. If you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation. You can learn more about our services by visiting our website at retirerelax.com.
And if you'd like to contribute to the show, you can email me, randy@rfmoney.com, with a question or a topic that you would like for us to cover in a future broadcast. And we look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.